certainly much of the attention from the market has been one on economic resilience and obviously the Fed's path forward. But then on the other hand, Trump policies has very much been in the driver's seat here over the last several trading days. I'm curious what you think this all means here for the bond market. We have seen the steady climb higher, to say the least, in yields. Are we heading back towards that 5% level?
Sure, and thanks for having me, and good morning. Short answer is yes. We actually do believe that we are going to retest recent highs in the bond market. Setting aside the policy dynamics, the reality is that inflation is heading higher. Inflation, in our view, as we trend into the middle part of the year, we think the risk is that it's closer to 4% as opposed to the policy target of 2%. This, in and of itself, will put pressure on bond yields, upward pressure on bond yields. Then you marry that with policy risk. This, to us, just adds up to bond market volatility. This will persist.
And so how high do you think we could eventually scratch or continue to go with this type of trend line that we've been tracking?
Sure. It's, putting a target on the bond market is sort of obviously an extremely difficult exercise. What I would suggest is that based off of what we know now, based off of the inflation dynamics, based off of the potential policy mix, retesting that 5% area on the 10-year is not out of question.
Steve, when it comes to, I guess, the biggest drivers or what is going to ultimately get us there, when it comes to, there hasn't been as much talk maybe lately over the last couple of days about Fed policy and what that is going to look like there going forward. I'm curious what your base case is right now for what the Fed is likely to do here over its next several meetings.
So I think we need to separate that into multiple time horizons. I think in the shorter term, consensus is more or less correct. We likely get one more cut at some point over the next 1 to 2 meetings. Our concern is more in the back half of the year. If our view around inflation pressures building proves to be correct, the Fed will ultimately be forced to pivot, right? And to be clear, I'm not suggesting that our base case is that hikes get priced back into the market, but it is a condition and a probability that we need to be very mindful of.
And so that probability, as you're kind of gaming out, especially the markets right now, are essentially pricing in 2 Fed cuts and really, if we were to see 2 back half of this year. If we were to only see 1, what would the Fed need to see in the data? And then what would the reaction, you believe, be in Treasury yields?
If for the Fed to only cut once or potentially be done with the cutting cycle, it's very simple. It comes down to inflation. If our views around inflation prove to be correct, and again, we see an upward bias in inflation pressures over the next 2 to 3 quarters, that'll introduce conditions where the Fed will be forced to pause their cutting cycle. And the market at that point will likely be pricing in hikes.
Steve, the potential for the 6% level in a note that your team put out not too long ago really garnered a lot of media attention. Lay out that scenario and not so much how likely it is, but what would then likely drive us to that level?
I think there's a lot of debate, appropriately so, and discussion around the Trump administration policy set. What we're really focused on is the sequencing of the policy set. If we get front-loaded fiscal stimulus, if we sort of front-run, tax policy, deregulatory policy, all the things that ultimately prove to be stimulative, those are conditions where you exceed 5% and potentially reach that 6% area. The counterpoint to that is that there is potential for fiscal tightening, right? It's a low probability event. But in the event that we get more tightening fiscal policy, that obviously would introduce a risk to our view. But our guidance here and our expectation here is really just to focus on the policy sequencing and the mix, as opposed to trying to time it.
So would it be tax cuts or would it be tariffs that would have the larger, perhaps, kind of net impact to yields from this juncture, if we were to track towards that 6%?
Sure. If we front load tax cuts and front load easing in fiscal policy, that gets you to that 6% target much more rapidly. If we reverse the order, if we end up with tariffs first and then potentially fiscal stimulus later, that introduces some risk to higher yields. Again, I really want to emphasize that it's about the sequencing of policy. We can sit here, we can track headlines, we can sort of chase the latest narrative. What we're really focused on is the sequencing of policy. And if you get the stimulus first, that introduces an upward bias to yields.
All right, we're going to be tracking this closely, as we know you and your team will as well. Steve Boothe, thanks so much for taking the time here.